Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is June 30 and this is a weekly markets update. Let's have a look at the news of week 26 and see what are the next trends. The escalation between Israel and Iran was already called 12 days war and finished with ceasefire agreement. The globe hopes that this ceasefire will be stable and no more shocks will shake commodity markets. Urea price responded to the news immediately. In the middle of last week, Israel announced that gas production at Leviathan gas field is resumed, so Egypt will receive it very soon, and expectation is that fertilizers production will be resumed at the beginning of this week. However, Egyptian authorities informed the market that first priority will be the needs of domestic buyers, who are now in its peak consumption season. So, looks like July export supply from Egypt will be limited. On top of that, 2 weeks of production halt resulted in the loss of around 100 to 125,000 tons for international market, at least. Iranian producers also expect production to resume this week. Lord Dogan already announced a sales tender for 25,000 tons of granular product that closed on Saturday. It will set the new level for Iranian supplies in July. Stoppage of Iranian plants resulted in the loss of between 200,000 and 250,000 tons of product for the international market. Algerian product peak sales was at $536 FOB, and producers seem to be largely committed for the first half of August, while future price target is put at unrealistic as for me $550 FOB level. European market is definitely not ready to accept such levels, especially taking into account historically low affordability. Supply from the Middle East was under the highest risk during the escalation, of course. Thus, the price moved as on the roller coaster. The highest registered sales from the region was from Oman at $525 FOB for August shipment. The vast majority of deals for July shipment happened in the range between $480 to $95 FOB. However, in a day after ceasefire, when it became clear that it holds, prices slipped to $435. Still, the Indian tender will give support to the regional prices in July. Dangote closed a sales tender on Wednesday last week for 3 cargoes of 30,000 tons each for July. Producers' target is rumored to be around $425, but actual sales likely will be in low 400s FOB. The awards will appear this week. In China, the idea of export quota increase by as much as 2 million tons is discussed, however not confirmed yet. For now, current pace of export inspections is quite low, and looks like even a regional quota might not be realized. So in order to increase the export volumes, Chinese authorities need to expedite the formalities. Last week, Chinese granular urea FOB values peaked at $435 and then moved down to the range $420 to $30. For now, Chinese producers are reluctant to commit for August. In Indonesia, Pupuk sold 45,000 tons of granular product at $452 FOB in a tender. There are several more cargoes available for July from the producer. European demand was lucrative again last week, with buyers more focusing on nitrates. Only small spot inquiries circulated for supply to Ukraine and Bulgaria. In Latin America, buyers' interest quickly evaporated as prices started to move down. At the peak of the Middle East escalation, deals to Argentina were discussed at the level $510 to $20 CFR. However, prices quickly dropped $450 level. In Brazil, $450 to $60 CFR level were targeted by suppliers at the beginning of last week. But then, values dropped to $425 to $30 CFR. Chinese product was confirmed to be sold at this level. And finally, let's move to the Indian tender, fresh one, that was announced last week. RCF is seeking 2 million tons of urea to be supplied to both coasts before August 22. The tender will close on July 7. As we discussed last week, India needs to act fast now, and that's what they do. In the peak demand season, Indian authorities have to supply farmers. Of course, 2 million target looks almost unachievable without Chinese product. But just about 1 million tons is doable. The tender will keep the price level elevated this week, that's for sure. Market participants will be cautious not to drop the level. So let's see if this tender finally is successful. Paper values all corrected down, and corrected down significantly. For all geographies, for all benchmarks, the drop was between $20 to $50 and even more. And this happened very quickly in the course of the week. Ammonium sulfate market was active again last week, with prices increasing more at the beginning of the week. Chinese standard AMSUL price increased to the level $180 to $90 FOB following 2 sales tenders that closed last week. Compacted product price peaked at $210 FOB before settling at around $200. Supply is now understood to be tight for July. Brazil was purchasing actively, not that much as a record week ago, but still quite sizable volumes. Compacted product was mostly sold in the range $215 to $20 CFR, with the peak purchase registered at $237. The main purchasing season is approaching in Brazil, so taking into account that the market is the largest global AMSUL buyer, the global price level will remain supported in upcoming several months. Southeast Asian markets also demonstrated some demand. However, price level of $210 to $15 CFR basis Chinese material was mostly rejected by the buyers. The nitrates prices continued increasing last week. All European majors that previously withdrew offers amid rally in urea market came back with renewed price lists. Yara, LAT nitrogen, and CF all raised prices in Europe and UK respectively by 25 to 50 euros depending on the market and product. We will see how downward correction in the urea price will affect nitrates prices, as we know very well that price is easily climbing, but downward correction is painful. In Bulgaria, Neohim has restarted its nitrate and nitric acid plant. Agropolychem increased prices constantly in the course of past 2 weeks, and last week offer was at the level of 375 euros FOB. Baltic prices also jumped last week. Tunisian tender for nitrate purchase was closed last week, and it is understood that it will be supplied from Baltics via one trader sourcing from different Russian producers. Because the tender was announced 2 weeks ago, before the rally in urea started, price proposed is much lower versus current level. The shipment will be conducted at $260 FOB Baltics, while current level at limited sales to Brazil is already $310 FOB. Now supply from Baltics is very tight, also taking into account Eurochem plant's production stop because of drones attacks. In the ammonia market, the main news of the week is the settlement of July price in Tampa between Mosaic and Yara at $417 CFR, which marks $25 increase versus June value. This confirms general trend at upward price correction across markets as a response to mounting supply disruptions. Ammonia is the only market which hasn't immediately reacted at Israel-Iran escalation, but finally it has. The other factor supporting upward trend is discussion in Trinidad that gas supply potentially might be curtailed later in July, as it happened already in previous years, which might significantly affect supply from one of the major producing hubs west of Suez. The most significant price increase happened in Turkey last week, with CFR level adding almost $90 to previous level. Turkey was mostly relying on Iranian and Egyptian supply, and both sources were impacted. Thus, Turkish buyers had to accept higher level from other suppliers, like Gemlik, that will receive Russian cargo at 500 CFR in mid-July. In Europe, prices added $20 and now are evaluated at the level of $460 to $70 CFR. FOB prices in Middle East also moved higher in line with global sentiment, but only by $10 to the level of $290 to $320 CFR. The increase is supported mostly by Indian demand, where buyers had to step into the spot market after losing Iranian supply. Phosphates market was not directly affected by geopolitical tensions. However, bullish trend still dominates in the market, and prices increased last week everywhere globally. In India, Coromandel International Limited has agreed phosphoric acid contract prices for Q3 25 deliveries with Jordanian's GPMC at $1,258 CFR with 30 days credit. This is $105 per ton increase from the Q2 price. In general, India continues to be the driver of global demand and price increase respectively. CFR price on recent sales was registered last week at $782 for Jordanian product, similar level that Jordanian product was sold to NFL tender. However, higher price level is already felt in the air as Chinese supply for July will be limited and Indian demand is there. For example, Hurl issued a new purchase tender for 50,000 tons of DAP for shipment to the West Coast closing today. Also, there are rumors about discussions between Indian buyers and Russian suppliers. The level circulating is $790 to $94 CFR, but this is unconfirmed for now. So, let's see where this rally brings the markets. Bangladesh will add to the tight supply-demand situation because market expects an annual purchase tender to be announced later this week for about 500,000 tons of DAP and 200,000 tons of TSP. This tender will set the direction for the market, and especially for Chinese product price level. OCP reported multiple small sales to Europe at the level $780 to $80 FOB for loading in July and August. The market expects now more clarity if future sales prices will support level over $800 achieved, or rather will settle lower than this threshold. NCIC announced a sales tender for 20,000 tons of DAP, 10,000 tons of TSP, and 30,000 tons of SSP that closed at the end of last week. We will know the results this week. There was no activity in Brazil as well as in the US market. Chinese exporters continued increasing prices. Last week offers were at the level $745 to $60 FOB, and producers are already targeting $10 to $15 higher than that. However, supply volume from China is still the main challenge for the global market. If DAP exports don't significantly increase as of July, tightening of global supply will push prices even higher. But affordability will not let the farmers to purchase. That's the problem. So let's see if China lets more exports to flow. Moving to the fundamentals. European natural gas futures fell below 34 euros per megawatt hour after a surge of last week due to easing of geopolitical tensions, as well as strong supply and weak demand. A ceasefire between Israel and Iran appears to be holding, reducing fears of supply disruptions. Norwegian gas exports to Europe have increased, while demand from power plants has dropped, as wind and solar output remain well above seasonal norms. This has further eased pressure on gas markets, though renewable generation is expected to return to normal next week. Additionally, gas sent out from Northwest Europe may decline as French LNG terminals undergo planned maintenance. US natural gas futures jumped about 5% to $3.7 per MMBtu as LNG export activity started to recover. Gas flows to the 8 major US LNG plants averaged more than 14 billion cubic feet in June, higher than early in the month, as some plants resumed operations after maintenance. Also, forecast indicates hotter than normal weather through at least mid-July. Meanwhile, after 10 straight weeks of above-average injections into the storage, analysts now expect smaller additions, as utilities used more gas for power generation during the recent heat wave. Agricultural commodities future prices all dropped last week. Wheat futures decreased dramatically during the week to the level of $5.25 per bushel, driven by the well-paced US harvest and rising expectations for Russian output that kept the focus on ample global supply. Russia's 25 wheat production outlook was revised higher to the range between 83 to 84.5 million tons. At the same time, last week's dry weather in most of Argentina boosted 25-26 wheat planting, following heavy rains in May. The global focus now shifted to the USDA's June report that will be issued today. Corn futures also dropped to $4.2 per bushel, as improving U.S. weather forecasts and ample supply projections have undercut earlier worries over crop stress. After a stretch of extreme heat, the National Weather Service now predicts beneficial rainfall across key Corn Belt states, relieving moisture deficits for recently merged fields. Those rains arrived just as USDA export sales data through June 12 showed only tepid demand. Meanwhile, U.S. ending stocks estimates for 24-25 remain elevated, reflecting both a record large planted area and robust yield prospects. And the recent 11.5 million barrel draw in crude inventories has done little to boost ethanol margins. Soybean futures corrected downward as well to the level less than $10.3 per bushel. Gains of previous weeks were capped by favorable growing conditions in the U.S. Midwest, where warm weather and rainfall have supported strong crop development and likely will improve soil moisture further. In Brazil, farmers are estimated to have harvested a record soybean crop earlier this year. Meanwhile, a recent report showed soybean sales in Argentina doubled in the first 3 weeks of June from a year earlier, as farmers raced to close deals before a planned hike in export taxes on July 1st. All eyes are now at the upcoming USDA's report. Moving to the shipping industry. Containerized freight index dropped by another 200 points last week, again due to the low demand for US-bound cargo. Freight rates from China to US dropped by 15 to 20%, depending on the cost. Freight rates from China to Europe hovered at the level similar to last week. Market analysts believe that there will be more downward correction in the second half of 2025, as soon as US-China and US-EU tariff situation will be clarified. The Baltic Exchange Trade Index dropped more last week, mainly due to significant activity reduction in Capesize segment. The sentiment was steadily weakening during the week amid persistently low activity across both the Atlantic and Pacific basins. For the Panamax sector, the week was rather positive, after several subdued weeks, especially for South America. Asian basin also saw a decent volume ex-Australia at the end of the week. Ultra-Supramax segment was again positional last week. The Handysize segment saw a mixed performance with modest shifts across both basins. The continental and Mediterranean regions remained subdued, with rates slipping below previous levels as the soft trend persisted. The South Atlantic maintained its momentum, while in Asia, market conditions remained steady. To sum up, Israel-Iran ceasefire deal crushed urea prices, which showed very quick and significant downward correction in the course of last week. Egyptian and Iranian production is back on stream, with the product available in the international market very soon. At the same time, fresh Indian tender for 2 million tons that will close early next week will support price trend in July. Of course, depends on the outcome, as there might be surprises. We have seen those. Chinese exports might be another surprise to the market, as the authorities are entertaining the idea of increasing urea export quota by 2 million tons. The question is if the export inspection system is ready for such amounts. Ammonium sulfate price followed urea price dynamics, retreating from the highs of last week, while nitrates prices in Europe seem to be completely disconnected now, with producers issuing new price lists with increased level again and again. The affordability worsened even more, and I wonder when the buyers will completely withdraw from the market. Phosphates prices continued climbing, as if global volatility is not touching the market at all. However, Indian demand and lack of Chinese supply is still supporting the trend. India's CFR level of $790 plus is definitely a new normal already. Gas price in Europe collapsed amid geopolitical tensions ease and stable supply. US gas price, on the contrary, increased on the back of very healthy LNG flows and hot weather. Agricultural commodities future prices dropped amid increasing supply valuations across the globe. Today's USDA report will show more direction. Container shipping activity decreased more as a result of further demand reduction from China to US. Bulk shipping activity slowed down, mainly due to decrease in Capesize segment. So, let's see what is next around the corner. But it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.